The past few weeks have reminded us of the influence of the Fed, the US central bank, on financial markets. To put it short, the chairman of the Fed, Ben Bernanke, has outlined a roadmap toward a reduction and an eventual exit of the bond purchase program that you know as quantitative easing, QE. The pace of reduction will be subject to development of the US economy, in particular the unemployment rate. According to the Fed's own economic forecast, which we find pretty optimistic, the end of QE would take place in 1 year, during the second quarter of 2014. This has triggered a correction across fixed income and equity markets, with a sharp increase in US bond yields. While per se, an increase in bond yields from a very low level is not a bad thing, because it reflects an improvement in the underlying economy, too rapid an increase is, however, usually problematic for markets in the short term. In addition to that, sentiment has been hit by a series of events in emerging markets. Let's start with China. The Chinese authorities have shown their determination to curb excess credit growth in the country by letting short-term interest rates go up to 12%. Even though in the meantime, the Chinese central bank has addressed the liquidity crunch, there is no doubt about the message addressed to banks that are engaging in reckless lending. Do not count anymore on unlimited and cheap money from the central bank. While it is not bad for the longer-term sustainability of China, this has negative implications for near-term growth, as we mentioned at earlier occasions. And we believe that countries and sectors which are heavily exposed to China will have to adapt to a less supportive environment. In that context, commodity prices will most likely remain under pressure. Beyond China, social tensions in Turkey and Brazil have triggered a sell-off in emerging market debt. While there has been some deterioration in their current account balances, the credit quality of emerging markets remains robust, and most issuers, most of these countries, are in a much better shape than in the past. We stick to our overweight stance versus emerging market debt, with a preference for external debt, i.e. denominated in US dollar, versus local currency debt. Overall, we have not changed our scenario. We expect the US economy to gather momentum in the second half, Japan to continue its recovery, and the European economy to gradually recover. That being said, given the fact that the two largest economies in the world, the US and China, are tightening or will tighten financial conditions, implies some remaining risk in financial markets. This is the reason we have been raising some cash in our portfolios up to levels of 20%. We have not changed our medium-term constructive view. We keep the same set of preferences, the same investment themes. However, we are keen to have a bit more flexibility in the period ahead.